Good morning or afternoon, depending on where you are, everyone, and welcome to today's RAAS Research Group Stock Take webinar. My name is David Tasker, and I will be your host today. The Stock Take series is designed to give you, the investors, an independent research perspective on an ASX-listed company, followed, importantly, by the insights directly from management. Today, we're focusing on Pointerra Limited, ASX code 3DP, a business that has developed the world's fastest true end-to-end digital twin solution, underpinned by proprietary patented algorithms and AI. We'll begin with a detailed analysis from RAAS Senior Analyst Finola Burke and founder of the RAAS Research Group, who recently released a comprehensive research note on Pointerra, covering results, forecasts, peer group analysis, valuation work, and key sensitivities. Then we'll hear directly from Pointerra's Managing Director and Global CEO, Ian Olson, who will take us through the company's corporate update. And importantly for you, we'll finish with a moderated Q&A session, where I'll put to both Finola and Ian a range of questions submitted by you. So jump in at any point and ask a question using the Q&A button at the bottom of your screen, and I will ask Ian and Finola those questions on your behalf. On that note, I would now like to hand over to RAAS Senior Analyst Finola Burke, who will go through her presentation on her Pointerra analysis. Finola, over to you.
Thank you, David, and thanks for hosting today, and thanks, Ian, for joining us, and thank you to all the participants today. We might flip through next slide, please. Usual disclaimers. So I will go through our thoughts on the FY25 results. We'll also look at our outlook, peer group multiples and discuss our valuation approach, and look at some of the key sensitivities and risks that we have in our forecasts. Next slide, please. So just on the result, look, it was a good result. Didn't meet our forecast, but it was a very good result, and for many reasons. You saw total revenue increase by 45% to 11 million. The EBITDA loss was substantially reduced, and it was a 4.4 million improvement on FY24. Underlying NPAT loss was just 0.8 million, and that was an 81% improvement on FY24. The reported loss was 1.7 million, and that was a 3.5 million improvement on FY24. And so one way to look at this is that more than 100% of the additional 3.4 million in revenue generated in FY25 dropped through to the bottom line. Next slide, please. It was very much a tale of two halves. We were really pleasantly surprised with the first half. It was absolutely a great result with good revenue generation, 7 million, and really good cost containment. That cost containment continued through to the second half. We still saw a reduction in overall employee costs. Underlying operating costs were held to just 6.7%. But revenue obviously wasn't what we'd hoped, but it was still good revenue. It was still contributed to the full year. And I think that cost containment holds the company very well going into FY26. Next slide, please. So just on the peers, we haven't got any. There's no one company that's just like Pointerra, but there are a number that have touch upon similar sort of businesses. So they either have data analysis, they're digital, they generate digital twins, they do digital assessments. So we view Asset Vision, ASV, IKE GPS, code IKE, and Veris, code VRS, as the most like Pointerra. As you can see from the table we've put together there on FY25 results, on EV to revenue basis, Pointerra is trading at a bit of a discount to the median of those peers, and certainly quite a significant discount to both Asset Vision and IKE GPS. We do think Pointerra is one that probably deserves a bit more of a premium, possibly, should be trading in line or even a premium, given that they have a superior gross profit margin to the median peer. And obviously, over time, we would expect them to have a superior EV to EBITDA margin as well. Going through to the next slide, please. So when we look at GPS, and the reason we just look at GPS in this analysis is that it's the only one that actually has forward estimates published by brokers. So they've got 4 brokers under coverage. So according to LSEG, only IKE has broker coverage. I think Asset Vision and Verus do not at this point. So consensus for revenue for IKE GPS over the next 3 years is forecast to grow a CAGR of 17%, and analysts are expecting for EBITDA to turn positive in FY27 and to accelerate in FY28, as we've highlighted in this table. Next slide, please. From Pointerra's perspective, we're forecasting a similar trajectory for revenue growth. We're looking at a CAGR of around 25% over the next 3 years, and we expect Pointerra to deliver positive EBITDA in FY26 of 3.9 million. We think they're closer to profitability than IKE GPS at this point. Now, a key point of difference between the two companies is that IKE continues to have around 13% of their sales from lower margin hardware and other services. And I think the forecast EBITDA margin and gross profit margin from Analyst is much lower than what we're forecasting for Pointerra. Next slide, please. So from a valuation perspective for Pointerra, we see the discounted cash flow methodology as the most appropriate, given that they are still on the cusp of profitability. We do use a fairly tight discount rate of 6.5%. That includes a beta of 1.9. The LSEG observed beta is a little lower at the moment at 1.83. And that's come up a little bit from 1.33 about 2 months ago. From an implied EV to revenue multiple basis, our 25 cents a share valuation implies a FY26 EV to revenue multiple of 12.9 times and 8.6 times FY27. Currently, the company at 4.7 cents a share is trading on 2.3 times FY26 and 1.3 times FY27. Next slide, please. I always like to do a bit of a sensitivity analysis because on valuation and on forecast, because invariably with earlier stage companies, things can be slower than you expect, or they can actually speed up faster. So just on a plus or minus 10% sensitivity analysis, there is quite a range. On a minus 10% sensitivity, we're looking at our valuation would be 10 cents a share. On a plus 10% sensitivity, we're looking at 41 cents a share, all else being equal. Next slide, please. The key sensitivities and risks in our forecast. So obviously the main driver is that growth in revenue, which is driven by sort of our contract expectations. So our forecast on a 10-year CAGR, I think, as I said before, is for 26%. Our forecasts incorporate operating leverage as revenue grows. We do expect the company to keep a tight rein on its costs. Gross profit margins we expect to remain at 95%, but over time that operating leverage on an EBITDA basis we think should rise from the 25% we're forecasting in FY26 to around 68% in FY35, and that's in line with the sorts of margins that we usually see from SaaS companies. Another key sensitivity, obviously, is that discount rate, which, when we see improved and sustained profitability from company, we tend to look at lowering the risk rate. So that would have an impact on our valuation. Obviously, ongoing investment by the company in increased automation, AI, delivers potential to drive down costs more than we had forecast. So again, that potentially is an upside in our forecasts. And that's all from me. Thank you very much.
Thanks, Finola. As always, great great insights, particularly around the financial performance, valuation framework, and peer comparisons. We do have some questions for you, but we will come back to you at the end when we'll go through the combined Q&A with questions for yourself and questions for Ian. Now let's turn to the company itself. Pointerra has been building momentum in multiple markets with enterprise contracts across utilities, defence, resources, and infrastructure. And its platform is increasingly being recognised as best practice in managing large, complex 3D data sets. To give us more detail on strategy, customer traction, and growth opportunities, I'd like to welcome Pointerra's Managing Director and Global CEO, Ian Olson. Ian will take us through the corporate presentation and then join us alongside Finola for the live Q&A. Ian, over to you.
Thanks, David, and thanks, Finola. And before I jump into my presentation, I'd like to thank the people that have taken the time to listen in today. A bunch of familiar names, some new names, and a bunch of the Pointerra team online who are also obviously shareholders. So thanks to you guys, and in particular to those of you who take the opportunity to reach out directly from time to time. Appreciate your interest and your passion for our business. Jump to slide 2, please, David. Thanks. So I'll move through this stuff pretty quick because I know most of you want to get to the Q&A. But I think, and David, you did a fantastic job of explaining what a great digital twin platform is. And I think one of the themes that I'd leave you here with is that we hear this a lot is, well, what's a digital twin? And it means lots of different things to lots of different people. But for us, it wasn't a phrase that existed 3 or 4 years ago. It's very much become a contemporary phrase. And what I will say is that every asset owner in every asset owner category, be it civil infrastructure or process infrastructure, built form, those businesses are undertaking some sort of digital transformation. And that digital transformation at the centre of that is a digital twin, the digital representation of their physical world. And it's kind of where we've ended up. Although we started life, with a very different product and a market sector focus, being the survey mapping and the AEC sector. But if we jump to slide 3, thanks. What has remained consistent, and this slide reflects some whiteboard notes that we've got pictures of from sort of 2015, 2016, which is the essence of our business. It's a SaaS business model. We deliver the ability for people to host, manage, build, maintain, and then analyze and interpret their digital twin data to better manage their physical world. There are a lot of buzzwords here, but the end of the day, our platform exists, and our people and our customers pay us money because we help them lower their operating costs, and we help them optimize their investment in sustaining CapEx. And those two themes, at the end of the day, are what people will pay you 6- and 7-figure recurring revenue for, to help them lower their operating costs. How do you do that? By removing clumsy, inefficient workflow, allowing people to share these costly yet valuable digital data sets across the enterprise. And as importantly, on the balance sheet side, particularly for the asset owners, some of our asset owners have tens of billions of dollars in civil infrastructure laid out across hundreds of thousands of square miles of territory. It's the ability to optimise the continued sustaining CapEx investment that's required to keep the lights on or to keep the road or the rail corridors running. Our next slide, thanks, guys. We've always been laser focused on cost. And I think an interesting statistic that I like to discuss is how we've got to where we are over our journey. I think since listing, we've raised just north of $11 million in Aussie dollars from shareholders and from the market. And during that time, our customers have paid us in excess of 40 million Australian dollars. So we've scaled our business to more than 30 people across principally two main regions, Australasia and the US. off quite a modest amount of investment capital, and have really relied and used and worked successfully with some of our larger customers to scale our business. We're really confident about the outlook for the sector, and that is the digital twin sector. We're incredibly confident about our product market fit. And I think in the last couple of years, and in particular in the last year, and even more so in the last 6 months, we've become laser focused on identifying or knowing what our ideal customer profile is. And when you're trying to convert long sales cycles and bring revenue and cash flow to market, which as you guys all know, we have to report every 90 days, the ability to shrink that sales cycle by focusing on customers or prospects that are likely to convert faster, because you've made every mistake you can make in terms of managing long sales cycles. That ideal customer profile across our different sectors is something we're really confident on. And what we know is that when you onboard those ideal customers who are ready, they're either in survey mapping and AEC. If we jump to the next slide, they're either using our platform to shrink their workflow, and these are the groups that that are producing maps and scanning the world, both from the ground and the air, delivering data to the AEC sector, who are designing and building and in some cases operating the infrastructure for those categories over to the right of this slide. I think we've always known implicitly what our ideal customer profile is for survey mapping and AEC, which is where this business started many years ago, just focused on those two sectors. And as many of you would know, we fell into the asset owner category by chance back in 2017-18, when we became aware of just how big the opportunity was from a total addressable market perspective in the asset owner category. What we've become really what we know a lot better now than we did, even a few years ago, but certainly this calendar year is how to quickly identify from our significant list of prospects in our pipeline what that ideal customer profile is, where to direct energy in terms of the sales cycle, and then bringing forward that ability to onboard those customers, deliver cash flow and earnings to this sometimes patient but often impatient and understandably group of people. So those 6 target sectors, they all have enormous total addressable markets. On the left-hand side, it's more around a seat-based. Survey mapping AEC is around our licensing. There's more around our seats, and we have different price points for those seats. Typical SaaS model for a business-to-business platform, a certain amount of dollars per seat per month, with some sort of data allowances. And then on the right-hand side, we tend to see a very different user profile where the customer might make way more use of analytics, interpreting their data, and may have a much larger quantity of data and a smaller number of users, or the flip side, a very small quantity of data and a large number of users. And obviously, during one of the holy grails for us is on the right hand side of that slide is defence and intelligence. And during the year, we achieved probably the biggest milestone in our history. And that was being part of the successful consortium for the GRIDS4 program in the US with our prime contractor Leidos. And whilst that program hasn't delivered any revenue yet, it's not unreasonable to expect that it will this fiscal year, but more importantly, out into the next couple. So again, enormous total addressable markets, an enhanced understanding of our ideal customer profile, which means that we should be able to accelerate the sales cycle and bring on those larger customers faster, and bring you guys and the company enhanced cash flows and and revenues whilst maintaining that focus on costs that we've not become famous for. We're just, we own a fair chunk of the company like you guys, and so we're pretty keen to make sure that we manage every dollar. To the next slide, thanks guys. I've kind of touched on this a bit since I've been talking, and I think and some of you have probably seen this slide before. Some of the wording's changed a little bit, and I think probably the big takeaway from this slide is the second from last panel. We've talked about structural tailwinds before, particularly in the US, around the federal government's infrastructure investment program. But what's changed in the last 12 months, and it's changed at an unprecedented rate in terms of our experience in governments and companies deploying capital, is the AI data center and associated, and the implications that the significant investment in those data centers has for the power sector in the US. It's unprecedented. There's hundreds of billions of dollars going into the ground. The data centers are typically being built on federal properties, federally owned lands, and with the current political climate in the US, the party in power at the minute has the ability to really fast track approvals, and so the pace, and I think everyone's really in awe of people like SpaceX and Tesla and how quick they go about it. Well, the rest of the tech world is catching up in terms of the speed of investment. And whilst it is chips and everyone loves the NVIDIA story, it's as much about concrete and steel, and then the connection to generation requirements, and then the interconnection of those generation requirements to the grid. That's the piece that has opened up a whole new story for our business. And so those structural tailwinds feel like they've just gotten stronger in the last year in particular, and there's years left in this journey, probably decades, in terms of civil infrastructure investment in North America, and the associated, newer investment in the AI data centers. What I will say is that a lot of Australian businesses go to the US with a ton of money and turn that ton of money into a very small pile. We went to the US in 2018 with a very small amount of cash, and have been able to scale a business, albeit not in a straight line, to the point now where we're seen as not an early stage business in North America. We've been there since 2018. We've made some significant and important changes in the leadership team in the US in the last 12 months. But where the company is positioned now, and what the outlook is for us, both through our direct sales efforts and through some of our channel partners and business partners, is just astonishing. So I'm really incredibly proud of the Australian team in supporting that US team, but also how the US team has dealt with some kicks in the guts over the last year or so, and how we're poised right now. It really is an exciting time to be part of our business. And if I can say, if we can leave something, a message for shareholders, it's a really good time to be a Pointerra shareholder. We're incredibly confident about FY26, but more importantly, what FY27 and FY28 look like. It really. We feel that a lot of the effort that we put in over the years, a lot of the sort of backtracks we've had to make when we've gone down wrong paths, it would appear that a lot of that's behind us. A lot of the program delays that we've experienced, where large asset owner customers have paused or delayed their aerial and mobile capture programs. The evidence on the ground, particularly in the last 3 to 6 months in North America, is a lot of that's behind us. During that time, we've also materially diversified our customer base, so we're not as reliant on the one or two large US utilities as we were, say, in 2021, 22, 23. So significant growth drivers in North America, but as well in Australia. I just think that there's less. The thematic's the same in Australia. There's just less zeros. So we can jump quickly to FY25. Again, I won't spend too much time on this because Finola covered it, and it's been out in the marketplace for a while now, since the 4E. And I think I'd echo Finola's comments, which is that the first half was was really promising, and and then we suffered some delays, particularly around some of our federal government, our DOE work, into Q3 and Q4, which obviously impacted revenue and cash collections. So not great, probably not even good, but a material improvement on FY24, and really sets the scene for FY26. Thanks, guys. Next slide. So I guess the key theme out of this slide is the fact that there's some detail here on the on the high level stuff from the slide before. Again, near cash flow break even. One of the great joys for us as a team will be when we manage to string together 4 positive quarters of cash flow in a row. I'm sure you guys will hate that, because then we won't be obligated to report the same. We'll always report quarterly, but the focus on cash won't be as prescriptive. And as everyone who follows businesses like ours knows, the quarterly cycle comes around really quick, and our customers' propensity to sign contracts and then pay invoices doesn't necessarily match our intensity in terms of delivering those to deliver the sorts of results you guys are chasing on a quarter by quarter. So I think Trump said something the other day about how odd it was that even the largest US New York Stock Exchange and NASDAQ listed companies are still focused on quarterly reporting, which was perhaps not necessarily the best way to operate a business from a strategic perspective. So the challenges exist for massive multi-billion-dollar companies as they do for little minnows like us. What I'd say to people is that the momentum that we've built through FY25 and into FY26 is going to generate some fantastic results, and we look forward to presenting those to you guys. Thanks. Next slide. Right, so FY26, we're a quarter in. I've already talked about DOE contract, the $2 million that was awarded in early in Q3, I think sometime in January 2025, earlier this year. We expect to see revenue and cash from that contract in the first half. As I mentioned a few minutes back, we expect to see program engagement through the GRIS4 program throughout fiscal 26, and hope that there will be cash and revenue from that. The partnership's one of the great opportunities with a business like ours wanting to remain lean is to work through resellers and partners, and we've been establishing a network of those over the last 3 to 4 years, and there's some names that will be familiar to everyone. People like AWS, our partner platform, Esri, the world's largest geospatial mapping business, some of the smaller emerging businesses, people like Emerson, and other hardware vendors like Teledyne Optech. So those partnerships give us fantastic reach and leverage without adding cost to the business. The downside is those businesses have other things that they're trying to do, not just sell Pointerra. So you get the good with the bad. But the focus remains building the right sales team to turn qualified 7- and 8-figure ARR opportunities into paying customers. We've become even more ruthless, particularly in North America, with the performance of our salespeople. I get questions from shareholders from time to time about, I saw person X was hired and that person's not here anymore. That happens. We try not to make mistakes when we're hiring people, but we've become a lot more focused and targeted in terms of performance against expectation, and then there are outcomes, where performance doesn't meet expectation. One thing that has changed significantly in the last 12 months is the use AI in our business, and not we've been using AI tools for our analytics and our platform for years now, but the rise of LLM models, and more importantly the different applications that are built on top of those that are available to SaaS businesses like ours at very modest cost, which codify some of the best practices in B2B sales pipeline management. We've been following and talking to a bunch of these really successful folk who've made careers out of generating 7 and 8 figure SaaS contracts for their employer, who've gone out into the consulting world and have been helping businesses like ours scale, and which is, in the US can be particularly challenging. But more recently, these people have started to build their own applications, their own SaaS applications that are largely built on using a bunch of different LLMs. Some of them are names that you guys would know, some of them are not household names, but codifying all of their experience into a platform that we can adopt in our business. And the objective there is to shrink the sales cycle, to put more deals in the front end of the hopper, to move them through quicker and turn them into paying customers. So in that respect, over the last 6 months, we've completely re-engineered our go-to-market strategy, completely re-engineered our go-to-market tool set, and that means we need a different type of human in the business in terms of account execs and SDRs than we perhaps did 2 or 3 years ago. It's any of you who've used an LLM know that it's raised the bar in terms of finding out about people. I know there are people on this call and finding out how businesses perform. There are people on this call who take our quarterlies and stick them into an LLM and ask the LLM to assess how we've gone, and then I get those questions back, which is a fun journey. But the ability to use those tools in our business has fundamentally reshaped the way we go to market, and it's and what does that mean for the company? What does it mean for shareholders? It means that we should be able to scale revenue, scale the top line, but remain even leaner in our fixed cost base. So that's really I think that's the big message for FY26. It's the ability to ensure greater quantity of higher quality leads in the front end, and then shrink the time that each lead is in the sales pipeline before it turns into a paying customer. And that's again, the final comment there, as we've always done, customer-led innovation. Our entire product roadmap, our entire dev team is focused on delivering solutions that customers want and customers have asked for, rather than things that we think might be a good idea. And that's always been an important part of our business and our culture, and how we've approached the market, and I think has served us really well over the last 5, 6, 7 years since we've started onboarding customers. Next slide, thanks. Which I think might be the last. Right. So yeah, it is our last. So what's our goal? Delivering shareholder value. What's shareholder value? Well, the simplest measurement is the share price. But what we know is that a large amount of the people on this call, and in particular the board, management team and founders, control a large chunk of the register, and but we also know there's a retail component out there who flit in and out, chasing trends, chasing good performance, bad performance, and so from my perspective, the short-term focus on the share price isn't going to deliver long-term shareholder value. What will is high margin, sustainable, profitable customers. And so I guess to recap, what does FY26, what does FY27, what does FY28 look like? We've got every deal that we'd ever need, even though there's plenty more that aren't in the pipeline, already in our pipeline, to deliver way in excess of the forecast that Finola has for us out to FY28. So those deals, most of them are qualified, are already in our sales cycle. We've become a lot more critical from an ideal customer profile perspective about where those prospects should be, and therefore where our energies are in terms of turning them from a prospect or a trial customer into a a prospect that's got a proposal in front of them and has accepted that and has started paying us money. So, those prospects are there. There's tons more to add, and the challenge is allocating limited resources, limited time to the highest quality prospects. And I think we've got a lot better at that in the last year or so. The channel partners I've talked about already, they are important, but they're only part of the story. The central box there, one of the key features of our platform and an ethos we've always tried to have, because it really represents best practice in B2B SaaS, is not just minimizing churn, but ensuring that those customers have a pathway to spend more with you, through adding extra users, through using more analytics, through building the amount of data that we're hosting for their digital twin. I think we've been pretty good at charting those pathways. We just need more of those customers. I've talked a bit about about enterprise sales professionals. Those professionals have, particularly in North America, the sorts of people that we need in our business now to execute are very different to the sorts of people that we needed just a year ago. And that's perhaps why some of you who pay a bit closer attention to our headcount and folk on our payroll through LinkedIn will notice that there has been some changes in that area. So it's not so much about a Rolodex anymore, because customers, getting to customers is incredibly more streamlined than it's ever been. The customers know incredibly more about you than they've ever known through the use of LLMs. So what you need is people with the business acumen to be able to explain the value proposition to a prospect of using our platform, and that takes a different type of person than someone who's just a sales animal. And what does all that mean? It means that we believe in FY26 and heading out that we should be able to scale our annual recurring revenue and do that whilst maintaining our high GP margin, but also being able to deliver real operational leverage very quickly with costs rising, fixed costs rising at a much smaller rate compared to the growth that we expect to deliver in top line revenue. Those doing that, and again, it won't be a straight line, but doing these things and doing them well will see us re-rate materially, in my belief, and then people can start to recall some of the share price action that we had perhaps during the COVID years, and certainly that's the objective of everyone in the business. We're almost every employee after they're qualified is a shareholder through our ESIP plan, and they're as laser focused as you guys are on seeing the improvement in the business reflected through our share price. So that's my presentation, and I'll chuck back to you, David, for the Q&A.
Thanks, Ian, for the overview of Pointerra's growth strategy, customer traction, and outlook. We'll now move into the Q&A session. A stack of questions have come through, so we're going to get through as many as we can. Apologise if we don't get through them all. We've allocated sort of 10, 15 minutes. Whatever we don't get through, I promise, will be answered by the company in due course. Ian, I've got a bit of an obvious question here, or it may not seem obvious, but it's come through in quite a few of the questions. There is a degree of frustration, and I suppose you feel it, in terms of the level of traction historically the business has achieved, and I think you touched on it in your presentation, some of the disconnect between contract win and payment for service. Are you as frustrated by that as what some of the shareholders may be? And I suppose the next part of that question is, how much is the business that was in 2020, 21 compared to how much the business is in 25 going into 26?
So yeah, I'm frustrated. I'm a shareholder too, David, so it frustrates the hell out of me. And what I can tell you though is that the business, it's not even the same business. 2020, 2021, I think we had, I'm going to say 10 or 12 people in the business. from a people perspective, we're nearly triple that size. The quality of customer, the diversity of customer, the removal or the reduction in the concentration risk around electric utilities in North America as being, sink or swim for the business, that's disappeared. It's still really important. It's still our biggest and most mature and the most successful part of our business, but the business doesn't look the same. It doesn't mean, but yet, here we are 5 years on, and we just did 11 million revenue, and sort of break even-ish. When's that big disconnect come between operating costs and revenue? And I think we're pretty confident that we'll be able to deliver that through FY26 and really set the business up. So, I can tell you that the management team, the sales team, are as frustrated as the shareholders in this on this call and across the broader market.
I will come back to you in a second, but I do have a few questions of Finola that I'd like to get to before I welcome you back. So, Finola, revenue is up 45% to 11 million, and underlying EBITDA loss reduced significantly. From your perspective, what does this tell you about Pointerra's operating leverage?
It tells me that they've taken a very strong view to keep their costs down, which is a good thing, because obviously, this is a business that over time we would expect, they've got gross profit margin in the mid-90s. Over time, we'd expect to see that EBITDA margin as revenue is driven and comes into the business, we'd expect to see that EBITDA margin to get up into the the high 60s, 70s, possibly even 80%, much longer term. So there is definitely operating leverage in the business, and quarter after quarter I've seen Pointerra, they have surprised us always on the cost basis, so that they've always come in, generally always come in lower than we've expected, or certainly from an employee perspective, they've kept it very tight. And obviously, in this sort of business, employees are your biggest fixed cost, and I think that they do it better than a lot of their peers. I look at Ike. Ike is still, same sort of bit, similar business, obviously a bit more of a hardware component for 13% of their sales. They did 25 million New Zealand dollars last year. They lost $6 million EBITDA. So, and their gross profit margin was at 69%, whereas Pointerra was at 94.4%. So, I see that Pointerra has greater operating leverage than, say, a company like Ike, and yet Ike's got a market value of 150 million and 4 brokers covering. So,
one thing I'd add there to what Finola just said, and to better answer your question previously, David, is that the fundamental difference between the business today, and particularly under the new US leadership team, and the business of 2020-21 is how we're engaging with the large enterprise customers, particularly the US utilities. It's a well-trod pathway in B2B sales with those large asset owners to start with programs and POCs, and then try and move from a program into and a program means there might be a labour component, there might be a subcontractor component. It might be an annual program, but it's still what we learned as we cycled a new leadership team in North America in the past year is that a lot of our customers, some of them had been with us for some time and had spent many millions of dollars with us, thought that we were a fantastic services business with a really cool software product, but we were essentially a services business that they could call on to be part of their program. We don't see ourselves as that. We're a B2B SaaS business, and yet through our actions and through the way that those customers had forced us to engage with them, they saw us as a services business, and we've worked really hard in the last 12 months. And as I said, in particular under the new US leadership team, and we pushed back really hard on contract at the time of contract award and during contract negotiation to ensure that the customer is onboarding us as a B2B SaaS platform that they can then use in time of either in a time of a disaster like a hurricane storm response, or as part of using our platform to host and manage their digital twin assets. And that's a fundamental difference. What does it mean? It means that the revenue mix is starting to look, and to Finola's comment about cost, if you go back over the last 3 or 4 years, you'll see some chunky contractor costs, third-party costs in our P&L. It's fair to say a lot of that's behind us. So we expect to be delivering more pure ARR, which is going to allow us to do what a lot of the people on this call have been waiting for some time, and ideally too long, which is when we start to report ARR, and it's close. I say that a lot, but it is close, and I'd like to think we will surprise people on the upside when we do put that maiden number out there. So again, a fundamentally different business, and I'd echo Finola's comments on operational leverage. Where it's something that we think will reveal itself over the next couple of fiscal years.
Just on that, Ian, the ARR is clearly one that shareholders hang on in terms of waiting, expecting, hoping for that. And I know you've touched on, the business is fundamentally a different business, and what's gone in the past has helped shape where the business is now, but the business should be looked at through a different lens. What is, I'm echoing some of the frustration. What is so different that gives you such confidence that this is a different time and a different business?
Well, existing customers completely revisiting the commercial model with them, and being more steadfast on migrating them to a SaaS subscription, rather than rolling into a nice, comfy, big, nice numbers, nice cash flow, but a program. So getting their people to use our platform. Onboarding a smaller customer, particularly in the survey and mapping, the AEC sector, those customers, they're right into the platform. We're seeing a material acceleration in trial accounts coming to the website, signing up, undertaking the 1-month trial, converting into paid customers. But again, that's at the $500 to $1,000 a month subscription. Those people never think about asking us to do the button pressing for them, to load their data for them, to deliver the analytics to them. It's only in the bigger companies where you're often forced to do things that you don't want to do. So it's just more discipline, David, more sophistication, more commercial sophistication in the US leadership team, and that translates into the ability to have a more intelligent conversation with either an existing customer and converting them to an ARR SaaS subscription rather than an annual program subscription, and then obviously ensuring that new customers are onboarded as a pure ARR SaaS customer. So look, talk's cheap. People have heard me talk about it'll be different. So we'll just see what happens, but we're pretty confident.
Maybe a bit of a direct question, and you've actually said, hit me with all the questions, so we're going to do that.
Good.
From your tone, you sound frustrated, less so in being questioned, probably more so on the customers who gave assurances or came on board in the past didn't deliver the way you thought, and that's transpired to I won't use the tech term pivot, but probably let's get this sorted mode that I can see in your voice at the moment.
Yeah, well, getting it sorted requires, because ultimately people buy from people. So you need the right people in the room. You need the right people on the bus. And the early stage leadership team that came on board in the US in 2018 were great and fantastic. Really good for our business, but the business matured and needed a different group of people at the helm, and so the people that we've got in senior leadership roles in North America right now are through their actions demonstrating that we've got the right mix. This isn't a problem we've ever had in the Australian market with the Australian customers, with the Australian go-to-market team. It's it's one of the challenges of doing business in North America. We speak the same language, but we're very different culturally. Their business practices are very different, and so you need strong, experienced, capable people to drive, to ensure that you stay on your track and not get sidelined into a commercial model that's convenient for the customer, but inconvenient for us. So so it sounds like doing business in the US is hard, and it is. I'd like to think we've made a lot less mistakes than a lot of other businesses we've seen in the past, and even Australian businesses there at the moment who are spending huge amounts of money and not, going sideways. So we're really confident in the team we've got and how we can scale that team under under our US leadership, and the structural tailwinds that we've talked about in the past, and with the addition of the on civil infrastructure, the addition of this AI civil infrastructure investment and the impact that's going to have on the electric power networks is phenomenal. So we're incredibly excited, and it feels different. I hope it sounds different, because it feels different in our business. We had the week before last, we had a global leadership team 2-day session, which included one of our board members in Brisbane. We flew some of the Americans out, and some of the guys from Perth flew to Brisbane, where Dave, our global head of revenue, lives, and we've got a satellite Australian office. And it was a fantastic 2 days, really setting the scene for 26, 27 and beyond. So yeah, incredibly confident, excited. We've been in this, Mark and I, and a couple of other founders. We started this journey just over 10 years ago, and we got our first customer about 8 years ago. We went to the US about 7 years ago. So we have been at this a bit, and we think that the investment that we've made, the time that we've put to this business, to our business model, to our customers, is going to be reflected in improved financial results that will put a smile on a few of the people's faces on this call, even the ones that like to be somewhat crude from time to time in their direct messaging. So that's just part of life in this connected world, where people love to lean into you and deliver wonderful observations into direct messages. It's one of the joys of being in a public company, isn't it?
I do have a couple of questions of Finola, so I'm going to jump to those now. Finola, your forecasts see Pointerra moving to positive EBITDA of 3.9 million in full year 26. What are the key assumptions behind that call?
Well, obviously, we're expecting some good revenue growth, and we're forecasting that revenue will rise to 15.4 million for the year, and we expect that the company will keep it's largely a fixed cost base with the staff and other operating costs. We have got some growth, but we think that the revenue growth will outpace the cost growth, and therefore that's how we're arriving at 3.9 million in EBITDA for the year.
And you're also forecasting a 10-year CAGR of about 26% for revenue.
Yeah.
What gives you confidence that this kind of growth is achievable?
Look, I think, as I said before, that's why we do the plus minus 10%, but as a bit of a cross check as well. But we do feel that once the momentum comes through on contracts, once these multi-year contracts come through, this company signs for a number of SaaS customers, that it'll grow from there. I mean, we've seen this with these sorts of companies with other companies that we cover, and we're quite confident that Pointerra can deliver on that. I mean, one of the things, while people might say, oh, well, the company has disappointed, from a revenue perspective, this company has still grown at a CAGR of 20% over the last 5 years. So it's not a failure. It has got customers. It's just the customers haven't always come through as expected. And my experience of covering SaaS companies and companies that are targeting enterprise customers over many, I've covered probably 20 or 30 companies over in my career on that basis, and in that sort of situation. And usually enterprise customers just take a hell of a lot longer than you're expecting to deliver. I mean, there's no impetus for a major corporation to take on a software contract. There's just they will move, the wheels move very slowly, and that's really unfortunate for companies like Pointerra, who've got a great product. But as one jumps on board, the others all want it.
Yeah.
That's what we think it'll come through. So,
Finola, we solve for that by ensuring that that we identify our ideal customer profile, right? So that's someone who has to make a change. So there's plenty of prospects in our pipeline who should make the change and are making the change, but not at the speed that everyone would love. And then there are customers who have to make a change. And often those customers are what we call challenger businesses. They're a new entrant to a market, or they're an existing entrant that's trying something different. And those customers, and we've onboarded a few this year, and we'll onboard a ton more in FY26. Those customers they're great because they need you, and they know they need you. So you've got a great product. I know I need you. What's the price? Let's negotiate. Let's go. Versus I think I need you, but I've been doing it the same way forever, and unless you can really convince me that you can lower my O&M expenditure and you can help me optimize my sustaining CapEx expenditure, which takes a while to convince, then I'm not necessarily going to make those changes. The prize, once you're deployed in an enterprise customer and you've changed, and you're not a program, you're not a services business with a cool software product, you're a deployed platform inside their business, you're integrated into their other enterprise applications, their SAP, their Oracle, their IBM Maximo work order management system, their Esri platform. Once you're actually integrated, and we're going through that with a large global mining company at the moment, you're there. And then there's two opportunities. There's three. There's failure because you just don't do what you should do. There's flatline because you're not clever enough at scaling. And then there's the scale opportunity. But the hardest bit's getting actually deployed. The easier bit is scaling once you are deployed. And that's why enterprise customers are so valued by the market, because it is so sticky.
Let's talk about contracts. Got a stack of questions about them, so we'll sort of get through as many as we can. US Department of Energy, US $2 million Gracie contract extension was expected to commence in Q1 full year 26.
Yes.
Can you update us on that one, and how is that going?
We expect that to be completed through FY26, David. And indeed, the first DOE contract, which was awarded, maybe it was this time last year, is nearly completed off the back end of that. And whilst there's good dollars involved in these, what comes off the back of it is US Department of Energy sponsored and managed webinars and presentations to the broader market, where that very important and powerful regulator in that country says to the power utilities in that country, hey, we see Pointerra as a best practice platform for storm response, for vegetation management, dealing with climate change issues and preventing wildfires, and for resilience investment. And as we know, there's hundreds of billions of dollars in resilience investment looking to go into the ground. So there's three things you need when you're doing something that involves civil infrastructure or any sort of infrastructure. You need dollars, you need people, and you need materials. So there's plenty of dollars. There are not enough people, and there are not enough materials. So everyone's competing for a limited amount of labour and a limited amount of materials. And so the message there is innovation. So how do you put the dollars into the ground before you lose them? You innovate, and that's why we're so excited about the DOE program. The Jarvis contracts, which we're expecting to firstly to be awarded in pre-summer and then in summer, The DOE has had a downsize in its people, not so much in its budget. So we're waiting eagerly for the outcome of those Jarvis contract awards, which are still pending. I know that's going to be a question. So
next one, as much a statement as it is a question. It was good to see Pointerra, Entergy, and Teledyne collaborating on a storm response product.
Can
you update us on the pole hardening contract announced in July 2023? Has Entergy started capturing data and a Teledyne product being used?
No, Entergy hasn't started capturing data, but we are at the table with Entergy leadership. They're a couple of years into their hardening program. They've not spent very much money, and the contractors that are spending the money for them aren't doing it in a manner that we believe is systematic and appropriate for the opportunity. So the good news, the pain is that it was a couple of years ago we announced the opportunity and our involvement. The positive is that we're still actively engaged with leadership at Entergy. Now, one thing to note about big US investor-owned utilities is that they do a lot of reorgs, particularly around the C-suite and the EVP and SVP suite. What does that mean? Those people move, and they move regularly. They leave, they do internal restructures, and so the success with that group of people is a series of sort of 2 steps forward, 1 step back, 2 steps forward, 1 step back, 3 steps back, 5 steps forward, and it just requires consistent application because momentum, can be challenging. But yeah, we're actively engaged with Entergy, which is really pleasing for us. And they've adopted our platform for storm response like FPL have. So we've now got 2 of the largest US energy utilities that turn to us and our platform, more importantly, when there's a big hurricane.
Amazon yard mapping. The last quarterly mentioned recommencement of the Amazon yard mapping program. How's that progressing, and how many Amazon sites are currently engaged?
Sure. So I'm not going to talk specifics because the good folk at Amazon wouldn't like that. But the yard project is progressing. It has recommenced. We are actively deploying the digital twin of an increasing number of their 700 odd distribution centers in North America, and so at the end of that, the prize for Pointerra is a 7-figure ARR contract with Amazon. One opportunity that has emerged, we've been responsible for mapping and deploying a digital twin of the external yards. In recent months, we've been talking to the people that operate the inside of the building, of the big box, and a lot of it's automated. There's a ton of robotics, and we didn't actually appreciate the opportunity for the extent of the opportunity for our platform inside the walls. So we're now looking to dovetail the interior mapping with the exterior mapping and deliver them a holistic digital twin of each site. And if anyone wants to know why someone like Amazon's doing something like that, they're preparing for a time when vehicles inside those distribution centers, a lot of it's robotics, a lot of it's automated, and they've removed a lot of people. They're looking to do that in the yard, and in particular, removing drivers from behind the wheel, particularly in the yards. And the objective there is increased speed, lower cost, and getting you that package quicker, which in America is breathtaking. The population of the US expect to be able to order a pair of shoes before work and have them on the front porch when they get home, and that's only possible if those distribution centers are as efficient as possible. So great to be embedded with Amazon. Great that they kept to their word, awarded us a contract a few years back, said, hang on, we need to pause for a bit, and now they've re-engaged. And there's a couple of guys on this call who shareholders owe a lot of thanks to for being resilient and sticking with that, because it would have been easy to walk away through frustration. But again, it's a 7-figure ARR opportunity, and I've been really impressed with how we've been able to stay engaged with Amazon leadership and then run it back to ground and get it cranked up again.
So last one on contracts, tier 1 mining company. It's been spoken about a little bit in the past. I suppose you're as frustrated as shareholders are.
No,
It is
not frustrated at all, David. That deployment of our digital twin platform into that tier one mining company is going as planned. The prize is scaling across 100 sites globally, and again, a fantastic chunky seven-figure ARR. So no, not if my messaging has led people to believe that something would happen that hasn't, it'd be great to be able to name them. We are going to get up and along with this customer and make some presentations at some global mining events. Probably in FY26. So really excited about how that's gone. It's given us a blueprint for how to attack other opportunities with other tier one miners. Tier one mining companies are just so, particularly the tier ones, they're so unique because they've got really geographically diverse operations, and at each operation they're not quite the same. It's either a different mineral class, or it's a different method of mining, or it's a different country, so there are different rules. So deploying a digital twin platform in a tier one mining company is very different from deploying a digital twin platform, let's say at Main Roads Western Australia or at Florida Power and Light. But again, the prize is significant, and our product team, and our dev team, and our customer facing team have just done a tremendous job of being successful, moving through the could you do this? Show us you can do this, and now we're deploying. We're going live. Right now in our first site in Western Australia, and we're going to scale to close to 100 sites off the back of that. So pretty exciting.
Sorry, there was one last question in regards, probably contract might be the wrong word, but Indonesia. There was reference historically to working with Indonesia to map out their vegetation and mountain ranges. How's that going?
Yes. So the Indonesian government's got some World Bank funding to map their country, and obviously LiDAR is a great tool. Strap it to a plane or a helicopter or a drone, and you can see through leaves, you can see through branches, you can see the ground, and you can produce high quality elevation maps. And obviously Indonesia is one of the largest countries in the world in terms of not just people, but its area, and it's tons and tons and tons of islands. And so that it's great to have a seat at the table at that project. It's early days, and again, it's a longer burn. I'd like to think we could see revenue in FY26 from that, but it's not a key part of our it's not a key part of our internal budget or forecasts, but it's important.
Time for two.
Sure, go.
I was going to say I got time for two more.
Yep.
So you've mentioned ARR a lot in this presentation, and it's probably something historically you'd agree hasn't been mentioned as much. It was all about win contract, get paid.
Yeah.
And the pivot of the business, or the enhancement of the business in the last 12 months, seems to be really around right customer, right engagement, and then right product mix to build that ARR. What do you think from an investor point of view? Clearly there are investors who are frustrated, so there's no point hiding from that. But what do you think from an investor point of view the focus should be over the next 6 to 12 months for them to go, aha, Ian's on the right track, Pointerra's on the right track, and they're delivering exactly what they said on the 1st of October 2025?
Sure. So what I'd encourage them to do is to look through the higher level numbers in the quarterlies. Look, take a look. Come and listen to some of our webinars, our customer facing webinars. Come and listen to look at some of our customer advocacy posts on LinkedIn, where we've got our customers telling the world, happy to say, hey, we love this platform, we love these people, we love this business, we love these guys. They've got our back. In any business in life, existing customer advocacy is the most powerful asset you can have, and by and large, the vast majority of our customers are happy to advocate for us. So to me, that's a demonstration of the quality of the. I mean, our longest serving customer is a fantastic entrepreneurial survey mapping business in Western Australia called RM Surveys. I signed them as our first customer in 2017. They're still with us 8 years later, and anyone who's owned or operated a small business knows that you don't spend money if it doesn't deliver value. So but all of that's great and it's warm and fuzzy. But if it doesn't result in dollars in the bank, then maybe it's all just a bit of fluff. So yeah, it's probably a mix of stuff, I'd say, David. Look at the results; they're important, but perhaps look through those and look at the quality of the relationships we have with our customers and understand what that translates to in terms of stickiness. And sort of the viral nature of our platform. And the one simple measure that I look at is our trial accounts. We run an internal platform or a comms platform called Slack that a lot of people would be familiar with. And I look at the trial signups. These are people coming to our websites, putting their details in, signing up for a 1-month trial. The rate of change of those signups going from a few years ago one a month to one a fortnight to one a week to one a day to multiple signups a day is sort of what we're seeing. So we're getting really viral at that sort of non-enterprise end of town, and like I said earlier and emphasised earlier, we've really worked hard to redefine the contracting method with our larger customers and ensure that they see us as a SaaS platform that they have to use, not a great services company that's got a cool software product that delivers something to them from time to time. So,
last question.
Yep.
The pipeline. Historically, you had a view on what you thought was coming through the pipeline, and you may have actually shared that with investors on things like this, and at times that hasn't dealt or hasn't delivered the results because customers didn't pay on time or didn't meet the requirements, I suppose, to make those payments. What does the pipeline look like now? I'm not asking you to make an overly large forecast, but what does the pipeline look like now, and how does that pipeline differ to a pipeline you looked at 2, 3, 4 years ago?
Yeah, well, during FY25, we cleaned it out. And we looked at each prospect and said, is this aspirational from our perspective, or are they actually on a journey with us? So it shrunk. It shrunk sort of in the first half of FY25, but we closed FY25, and more importantly, at the end of the quarter just finished with the largest dollar value in our pipeline in history. So unweighted. Let's just talk about unweighted. So it's better quality. It's a bigger absolute number, and we'd like to think that the investment we've made through some emerging tools to help us move each deal from hi, my name's Ian from Pointerra through to thanks for paying that invoice is going to shrink materially. So better quality in at more and better quality in at the front end, better tools and systems and people to help each prospect move through the sales cycle should equal better dollars and recurring dollars out the back end. So that's the plan.
And you said at the beginning, or certainly when this webinar was planned, that we would ask and answer all the questions that were thrown at you by shareholders. So I respect the fact that you have had a crack at every question that's been asked. There are a number still to be answered, and what we will do is we'll give them to you and your colleagues to answer over the coming days. But to you, Ian, and to Finola, firstly, thank you for the presentation and for participating in the Q&A.
Pleasure. Thanks for the opportunity, David, and for the 40 or 50 odd folk who listened in and those who are going to listen in when this is recorded and published. We're really excited, and I think, if I can leave you with one thing, I think it's a great time to be a Pointerra shareholder. If you don't want to be, then sell your stock or give me a call and I'll find a buyer for you. But you're not going to see any of the founders selling stock. We're really excited.
And on that note, thank you to everyone who's joined us today and for everyone who submitted your questions. For those who would like to read more, the comprehensive RAAS research note on Pointerra is available on the RAAS Research Group website. On behalf of RAAS Research Group, thank you again, and we look forward to seeing you at the next Stock Take webinar. Thanks, everyone, and have a